with Magellan Financial. I want to welcome everybody to today's call. Steph, are you on the line? Steph, are you there?
Yeah, I'm here, Alex. Hi, everyone. Yep, I'm here. Can you hear me all right?
Yeah. Did you guys want to do a quick intro?
I'm here, Alex.
Did you guys want to do a quick intro to get everything started this morning, or do you want me to just go ahead and start?
First of all, thanks for everyone for attending the webinar. We're very excited to be offering this webinar series. It's been extremely popular with our agents. The fact that we're able to host it live and also follow up with materials that can get you going is just an added benefit, and we're very fortunate to have Magellan as a partner and have Alex go through the presentation.
Okay, thanks, Steph. I appreciate everybody being on the call this morning. And again, at the end of today's call, we'll have a number that you can call, get a hold of Juliet, get a hold of anybody at the office. They can get these materials in your hands. Actually, just got an email this morning from Legacy and Americo that they are going to start, and actually I believe it's active on the website as of this morning. They are going to start illustrating accumulated values on this product, which, you know, those of you that sell indexed annuities know that that can sometimes be a challenge with some of the carriers. And you'll see with this product specifically, that's really what it's used for. So that's going to be a great advantage for us. One more thing I wanted to mention about Americo as well, for those of you who don't know much about the carrier and about their specific situation, a little bit smaller company. They've got about $6 billion under management, about 660,000 policyholders, and about 33 billion in in-force insurance business in general. They focus kind of on 3 or 4 different areas: annuities, life insurance, and final expense being 3 of those. Today we're gonna talk about a product that they issue through Legacy Marketing called the LibertyMark series. 3 different versions of it. Really, it's a straightforward accumulation sale product, so it's not designed to have the income rider. It's not designed to have the death benefit rider. It really is just a straightforward accumulation-based product, and I think you'll see that with some of the, you know, there's really where this is an advantage for you as an agent is a couple different things. One, competing with those other fixed assets that are out there like CDs, you know, even market-linked CDs, even bonds, you know, those type of things where you're kind of just looking to park some money and get a competitive fixed growth rate. These products, I think you'll see, have really some good upside potential. There's a 7-year version, so for those of you that like to sell a shorter surrender, I think that'll give you a good advantage there. Or if you're selling against a CD and it's a renewal of 4 or 5 years, whatever the case may be. And then commission. We'll go through commissions. I think these products really above age 80 going to be the most competitive commissions that you're going to see out there on the market. And really, from an accumulation standpoint, there's that story to tell as well. So it's good for the client, good for you as an agent, good for everybody. So let's go ahead and jump in here. The LibertyMark Annuity series, again, accumulation focused, 7-year or a 10-year surrender. So there's actually 3 different versions of this product. We'll touch on each and how they're each are a little bit different. Issue ages up to age 85. There's 2 of these products that issue to 85. One of these products, the version with the bonus that issues to age 80. So you'll see here the next bullet is a dual bonus. And what is that? I always get this question a lot because there's a lot of marketing companies out there that are saying, oh, this is a 15% bonus. You know, find the product with a 15% bonus. So I can tell you if you're seeing those emails, this is what they're talking about. I like to actually call it what it is. It's a 5% upfront bonus. It's called the LibertyMark 10 Plus, 5% upfront bonus. And then it's kind of unique to the industry and unique to the FIA space. There's a persistency bonus. And this is actually credited to the cash account. So 5% upfront day 1, and then after you get all your accumulation for the first 10 years, in the 10th year, at the beginning of the 11th year, you're going to get a persistency bonus of 10% of whatever added to whatever the cash value is. So pretty substantial, you know, even if you're averaging 4 or 5%, which in this product I think you'll see is pretty realistic. You know, you're going to get all those credits, and then you're going to get 10% on the cash value in year 10, not 10% of what it was when you initially started the policy. So no income, no death benefit riders. A little bit different on this. There's basically an asset management fee on this product. Even though it's a fixed product, there's what's called the optimizer fee. So essentially what you're doing is you're paying a fee each year, 1% on the 7-year product, 1.25% on the 10-year product, paying that fee each year out of the cash account in exchange for higher rates. So it's as simple as that. It's called the optimizer fee. For those of you who sell managed money, I think you'll see that, if you're moving people from a managed money account, they're used to paying these types of fees anyway. If you're not, I personally don't know anybody that wouldn't trade these rates for 1 to 1.25%. Now that being said, there's some people that don't want fees at all. So if you go down that road, we know what the solutions are there with the Allianzes and some of the other carriers that have no fees whatsoever. So let's take a quick look at the LibertyMark 7. Again, issue ages through age 85. You can see the surrender schedule on the screen here. Starts at 9%, very reasonable. 9, 8.5, all the way down to 4 in year 7, and then no surrender charge after year 7. The Liberty Optimizer fee on the LibertyMark 7 is 1% of the accumulation value calculated annually. And you can see commissions. Normally I don't like to lead with commissions first, but I think this product, if you're looking for a shorter surrender product that will still pay you a commission that's competitive with some of the other, longer surrender schedules, 10, 12, or even 14-year products, this is going to pay up to 7% through age 80. So, and 5% age 81 to 85. And I want to highlight that specifically because, that's a space where we as a marketing company and partnering with CBU, that's a space that's kind of hard to compete in sometimes. So a 5% commission age 81 to age 85 with a product that's a 7-year surrender, I just don't know how you beat that out there in the market. And again, from an A-rated carrier. Americo was upgraded by AM Best from A- to A in October of this year, so just this month. A quick look at the current rates. There's several different indexing options, and one of the handouts, one of the follow-up pieces that you'll receive from CBU will be it'll kind of go through examples of all of these products. Now that was all we had to go by when this product first came out. It's been on the market for about 4 or 5 months now. And really all we had to go on was the flat sheets that show you here's what it's done in an up market, here's what it's done in the middle market, here's what it's done in a low market, which I think are great, but with the new accumulation illustration software, I think it'll be that much more powerful and that much better to show to your clients. So you can show them, here's a realistic estimate of what your cash value is going to be at any given point in the contract. And again, for the 10 plus, it's going to show you that persistency bonus in year 10 as well, which is a pretty powerful story to tell. So if we look at the LibertyMark 7 and current rates, there's a few different strategies I want to highlight. One is the Dow Jones Real Estate Monthly Average, completely uncapped strategy. 100% of the growth with no spread. And again, it's going to be subject to this participation rate of 80%. So in this product specifically, you're going to get 80% of whatever the growth rate is, but there's no spread. The only fee is the Liberty Optimizer fee. So 1% off the top and then 80% of whatever that index does. And you'll see from some of the examples a little later on, it's a pretty powerful story to tell. It's got a gold strategy. It's got a 1-year point-to-point. It's got a 1-year point-to-point inversion strategy, which basically means if the market goes down, you're going to get credited positive growth up to 6.75% of those losses. So, if for now, this year, for example, may not be the worst idea to take a look at that inversion strategy. And again, you can come in and out of these strategies on an annual, 2-year, or 3-year basis, depending on what strategy you choose. So 2-year S&P point-to-point with a participation rate. Again, 60% of the S&P, the actual S&P itself. There's also a risk control strategy for those of you who are selling some of the products out there from Athene, some of the products from North American, some of the products from American Equity have these risk control strategies. And basically what those mean is there's a risk control target, whether that's 5%, 7%, 10%. None of that really matters. It's a volatility target. So that's what they're trying to generate, taking a little bit of volatility out of the equation so that the option cost is a little bit lower, allowing them to offer more participation. So 85% participation in a 2-year S&P risk control strategy, pretty top notch as far as that specific rate. You can see there is a rate change that's coming, and actually it's coming in 2 days here. So if you have any cases, you want to get these into Americo by the 28th. Okay, so you want to overnight those today if you want to hold these current rates. Going forward, and I know that's not realistic for a lot of you that are on the call today, going forward, the rates are still very competitive. As we know, the market's been trading sideways here for quite some time. And, you know, it's been up and up and up for the last couple of years, but we're really starting to see some signals. You know, the Treasury rates dipped from 2.5 to 3. It's now right around 2.25. For those of you who don't know, you know, our business is basically dictated by Treasury rates and option costs. So the yield that an insurance company can get and also the price they have to pay for an option really determines the rates that we're able to offer our clients. So if we take a look at this, you know, we're not going down dramatically. We still have 80% participation in the real estate average. We're down about 5% in all the other participation rate strategies. So still a very competitive story to tell on a 7-year chassis. If we look at the LibertyMark 10, and this is probably the most popular product that we're selling currently. We have some agents that sell the 10 plus because of the dual bonus, but we'll get into some reasons why this product is really our most popular right now. And it really is because of the nature of the product itself, what our agents are selling it for, which is, again, accumulation-based, competing against CDs, competing against those other fixed assets out there, trying to generate more than the 2 and 3 and 4% return that is your best case scenario in those specific allocations. So the reason why a lot of our people are using the 10 is instead of the 10 plus with the bonus is because the difference in rate and also the fact that this issues to age 85 instead of age 80. So on this product, it's declining surrender schedule starting at 12%, 10-year surrender, 1.25% annual fee based on the accumulation value, pays 8% straight through age 80, and up to 7% from age 81 to age 85. I challenge anybody, regardless of what the current rates are, to find any product that's paying 7% age 81 to age 85. So very competitive as far as commissions concerned. Current rates, again, same story. We're at 100% participation on the real estate strategy. We're even at 105% on the risk control strategy. We're going down to 90 and 100%, but still very, very competitive. 2.75% fixed rate is always an option as well if you want to blend some of that in to cover that optimizer charge. So essentially what a lot of our agents are doing is they're saying, okay, we have this Liberty Optimizer charge. If you want the net effect of that to be 0, we just need to allocate enough to the declared rate option in order to cover that. So in this example, it's what, about 40% that we'd have to allocate to the declared interest option in order to cover that difference. So now we're getting, you know, 60% of 90%, we're still getting about 55% participation in the uncapped strategy, and we're covering our fee. So a lot of people are blending the fixed strategy with one of these other uncapped options to make sure that in policy year 2, 3, 4, whatever the case may be, if you don't have any earnings, you're still able to show the client that they're at least even based on what they were the year before. So if we look at the LibertyMark 10 Plus, again, for those of you that like to sell the bonus product, we all know that you're giving up a little bit to get that, and in this case, you're giving up rate. You're giving up participation rate, you're giving up cap rate, you're giving up fixed rate in order to do that. Not to say you shouldn't sell this product, because the 5% upfront bonus to jumpstart those earnings to maybe cover some surrender charge coming in from another product might make a little more sense. And then the 10% persistency bonus at the end of the 10th contract year is pretty powerful. So in other words, if you started off with $100,000 in initial premium, and let's say it grew 7% just to make sure it doubles in that 10-year period. We all know 7% is probably not as realistic as it used to be, but let's call it 7%. We double our money. Now it's $200,000 in year 10. Well, we're going to get a 10% persistency bonus. We're going to get 20,000 additional earnings credited to that contract at the beginning of the 11th contract year. So it's not based on the initial premium that you put in. It's based on the full accumulated value at the end of year 10. So again, surrender schedule, very reasonable, starting at 13%, counting down in the first 10 years, and no surrender after the 10th year. This product issues to age 80, and it pays 7% agent level commission. Again, if we look at the rates, you can see, you know, we drop down pretty significantly when we look at, you know, this compared to the 10-year product, and it's just slightly lower than the 7-year product. So a lot of our agents are using the real estate monthly average. A lot of our agents are using the inversion strategy, the gold strategy, but you can see those are cap rate options. So, you know, if you're looking for real upside accumulation, the participation rate and spread rate products or spread rate index options are generally going to provide you more upside. Whenever you have more upside, you have more risk, because you've got to, you know, basically that index has to perform in order for you to generate that rate of return. So 2.25% fixed rate. We do have a 2-year and 3-year participation rate options as well. Again, a lot of our agents are using the Dow Jones Real Estate Monthly Average. A lot of our agents are using the 2-year S&P risk control with the participation rate. And when you get the handouts from Americo and from Legacy Marketing, from CBU, you're going to see, each one of these strategies explained in detail, how it works, what the indexing option is, what the reset period is, and what that looks like. So just a quick update here on the rate change so everybody has this info. Again, current interest rate and economic environment, essentially what that means is that interest rates are lower, which means the amount of yield an insurance company gets, which determines their option budget, is lower, meaning that rates have to be adjusted accordingly. Again, we're using the optimizer fee to buy a higher rate on this product. So you compare these cap rates, you compare these participation rates, you compare this upside against really anything out there on the market, and it's pretty hard to find something that stacks up against this product. So again, especially from an A-rated carrier, Americo recently upgraded from A- to A, so that the company's moving strongly in the right direction as it relates to their risk-based capital, as it relates to stability as a company, and their overall bond portfolio, which determines their ratings. So you can see the LibertyMark 10 and 10 LT. The LT just means that's the light version of the product, a little bit different surrender schedule. That's available in states that have specific, I believe Massachusetts would be one of those, in New England, but states that have more specific criteria as far as how annuity products can be structured. So you can see LibertyMark 7, LibertyMark 10, and LibertyMark 10 Plus are the 3 different products. These are how the spread rates and cap rates stack up across the products. And just to point out, I mean, you can see how much higher the cap rates and participation rates are on the LibertyMark 10, and that's really why it's become our most popular product within this series. And the fact that it pays 7% from age 81 to 85 certainly doesn't hurt that as well. So let's take a quick look at 2 of these strategies. This is the 2-year point-to-point S&P with an 80% participation rate. So again, it resets every 2 years. Is that really the right strategy for this year with the S&P at 1950 down from over 2,000 approaching 2,100? That's a conversation you'll have to have with your clients. For me personally, probably not a 2-year reset from this point. Might make sense to put it in a 1-year strategy, see where we are 1 year from now, and then maybe take a look at that 2-year reset option after the first contract year. So it's always, and for those of you who don't really know my background, my history in the business or whatever, I worked with CBU. I'm from Maine originally, worked with CBU, have known Ray for, I guess probably close to 10 years at this point. He really was instrumental in getting me started in the business. Since then, I've helped them develop the Social Security program, helped them test it in a lot of areas. We worked on putting that program together. So some of you that are using that marketing system, Ray and I worked hand in hand to develop that program along with Kevin, Jack, and Bruce, Rich, some of the guys in the CBU office that have been with Ray for quite some time. That being said, I think this fits into some of those assets from your Social Security seminars, from your asset preservation seminars. It fits into those assets that people are not generating a rate of return on, that they just like to look at in their bank account, but they're not going to use for income. Maybe it's CD money, maybe it's money that's just hanging out, not really getting them a positive rate of return. So that's where we've seen this fit in. The reason I like this product so much from a sales standpoint is it doesn't compete against some of your other products. It doesn't compete against your income products because it satisfies a different need. It doesn't compete against your death benefit products like the 222, the North American, Secure Choice. It doesn't compete against those products because it serves a different purpose, and we use it for different money. Obviously from a suitability standpoint, we've got to keep a certain amount of liquidity, but with a 7-year product, with a 10-year product, something that's going to generate these type of returns. You can see 100%. In an up market, we're 12.23%. Do I think that's realistic? Probably not. I mean, I think we're going to fall on this 2-year reset, probably more in the 5, 6, 7% range. But where else can you find a fixed rate of return of 5, 6, 7%? So pretty solid story to tell here. Obviously the down market, 2000 to 2010, we all know that as the lost decade. Anybody that's done, seminars with CBU and the like, that is the lost decade. So it certainly has a minimum guarantee, and in a lot of cases, most of our clients probably would not have even been back to even in that scenario anyway. So you can see it gives us a good range to talk to our clients about, gives us a lot of upside potential. The Dow Jones Real Estate Monthly Average Strategy, again, takes the monthly values every single month, gives you an average, uncapped participation rate. Right now, 90%, unless you can get that contract in. We can get you 100% if you can get that contract in to Americo by tomorrow. So obviously that's probably not realistic for most of the people on the call today. So if we take a look at this, 100% participation again, not quite as much upside as the 2-year reset with the S&P, but still a pretty strong story to tell. 1.8 in the down market, 5.06 in the mixed market, and in an up market close to 10%. So where else can you find that type of earnings potential inside a 10-year product? So really a pretty strong story to tell there from a accumulation standpoint. And again, this product, very straightforward, no income riders, no death benefit riders. All you pay is the Liberty Optimizer fee, which is 1% on the 7-year product, 1.25% on the 10 and 10 plus. So you're going to have all of this upside growth potential. On the 10 plus, you're going to get the dual bonus, 5% up front, 10% added to the accumulation value. Whatever that is in the 10th year, we're going to add that in the beginning of the 11th year. So I kind of stole a little bit of my thunder here to close everything out. But again, accumulation focused, great commission rates. 2 of the products, the LibertyMark 7 and the LibertyMark 10, are available through age 85. The 7 pays 5% from 81 to 85, and the 10-year version pays 7% age 81 to age 85. That being said, I know we certainly appreciate everybody being on the call this morning. We are recording it, so if anybody wants a copy of the recording, certainly get a hold of Steph at the office, get a hold of Shannon, get a hold of Juliet if you have need as far as illustrations and things like that. I want to thank everybody for being on the call this morning. Steph, unless you have anything else to add, we'll go ahead and wrap everything up. But the 800 number here on the screen, 866-275-3345. Give anybody at the CBU office a call. We'll certainly get everything in your hands and make sure you can have access to this very competitive accumulation-focused product from Americo.
Wonderful. Thank you, Alex, and thanks everyone for taking the time.